Breaking down today's market action, and again, we are going to break in with breaking news as soon as we get it here concerning the fire, concerning the president's speeches, and many other things. Very busy news day. Mark Lucchini from Janney Montgomery. He's not worried about the volatility derailing the bull market. Believe it or not, all those walls of worry can be climbed, he says. Christian Magoon from Yield Shares tells us why he's looking overseas. And Matt Jehn from Royal Oak Financial Group is joining us as well. Let's start with Scott Bauer at the CME. Scott, I want to start talking about oil. We did see a spike. It did still end up big time, over $50 a barrel, well over $50 a barrel. If the situation in Yemen does not improve overnight and tomorrow, are we looking for a further spike up?
I don't think we're going to see a spike, David. I think much of what you saw today was a lot of short covering because of what happened. I think these were a lot of people that were in positions, in short positions that said, oh, no, here we go again. So I think that's what caused the majority of this spike today. In fact, you know, we saw it this morning and really throughout the day, oil really hovered, you know, pretty much at the same level all day. So I'm still betting, unless we see some other escalation of this violence, I'm actually betting we see 45 again before we see 55. You know, the outside of the oil market today, the S&P market, there was really not a lot of volume, not a lot of conviction in this marketplace whatsoever.
All right. You know, Mark Lucchini, we've seen a lot of volatility today, and I'm sure that means that there is a lack of conviction because you've seen the VIX spiking for the fourth day in a row. That certainly has affected the markets. We're adding to more fear. Where's that fear coming from? Is it the Middle East? Is it oil? Is it the dollar? Is it the Fed? Take your pick of what we're afraid of right now.
Well, I think we're, first of all, in this data vacuum where we're not yet into earnings season. We don't have an FOMC meeting scheduled anytime soon. We're a week and a half away from a jobs report. And so the market's sitting here at the intersection of full valuation, 17 times forward earnings, and those estimates continue to be marked lower such that year-over-year earnings growth is negligible. On top of that, we don't know what the Fed is likely to do. And I think there's a non-trivial chance that this economic data we've gotten here for the first quarter is transitory. And as a consequence, if we see better data in the second quarter, that might spook the market into thinking the Fed's going to pull forward the liftoff date, and as a consequence, we could see further turbulence in the market. I think that's what's costing fear in the market.
All right, Matt, we had a big spike in interest rates today. The 10-year is now over 2%. And I noticed in your notes that you sent earlier, before it spiked that much, you said anything above 2%, you stay in equities. Well, it's above 2% in the 10-year. Do you get out of equities?
You know, I'm not encouraged to do that just yet. We still think the U.S. equities specifically is the place to be. The 2% yield, I mean, this could fall at any time. So we need to see some consistency as this moves up.
How long are you willing to sit with equities with the 10-year over 2%?
If we see 2.5, 2.6, I perhaps could be pulling back. But I don't think that's going to happen. I think you're going to see lower than 2%. We've had some volatility of late. But even when you look at all the news that's been coming in, both overseas and here in the U.S., the Dow continues to hover around the 18,000 mark. That tells me there's a real basis right here. And once these second quarter numbers start coming out, and perhaps we do see some good economic indicators, we are going to continue to push higher. I think here in the United States, we are really doing well, and we're just not talking about that. We need to start rooting for the home team a little bit more. We're going to do it.
Well,
the U.S. is the leader.
We're all rooting for the whole team, but you got to be realistic about what's happening with markets.
Hey, unemployment's going down, and the dollar is strengthening. We're finally empowering the consumer. And
so there's no excuse to keep interest rates as low as they are, if you're right.
Well, I think the interest rates are not going to go up exponentially over a short period of time.
Well, maybe not so, but Scott Bauer, I mean, look, let's be honest here. It is a dollar story. He's talking about, oh, the numbers are going to be good for the quarter and earnings are going to come in. We've already seen so many estimate blowback, fall. The estimates have been lowered. Excuse me, I can't even talk, Scott, because of the dollar. These U.S. multinationals are already telling us, like, the profits aren't going to be there. How can we celebrate earnings from a quarter when you've seen the dollar shoot up?
No question about it. And I think that is what the major concern of the marketplace is right now. Yes, overnight we had some, geopolitical concerns. That's the major concern, is what's going to happen with earnings season. How much further is the dollar issue going to impact earnings? I'm a homer. I want to root for the Cubs to win the World Series this year, but realistically, it's not going to happen. So, what am I going to do? I'm still going to root for him, but I'm still playing this cautiously. That's the same mindset you got to have here. Exactly. Same mindset you have to have here.
Christian, I got to give you a shout out because The last place in the world anybody wanted to invest over the past 6 months, say, is Russia. You think of all the problems, of all the countries in Europe that are having problems. I would put Russia up at the top, even above Greece, when you think about the geopolitical concerns. You said go with Russia back in November, and in fact, Russia has been, the index anyway, has been up. Why?
Yeah, well, I think, Sir John Templeton said it best. Where's the outlook most miserable? And it's been in Russia. I mean, the last 3 years, the market's down almost 40%. It was a kind of contrarian pick that I talked about. And sure enough, this year, Russia's up 17%, one of the best performing countries out there. RSX is a way to play it on the ETF side. And I think it was an overreaction. It's recovered now. And it's a way to kind of go against the grain a little bit and look at other countries besides the strong kind of economic background of the U.S.
Christian, I mean, if you look at overseas opportunities, and we've had a lot of analysts and traders come on and say, you got to look overseas until the U.S. squares itself away. What about other countries? What about other parts of the world that could actually give us the returns that we're looking for this year?
Yeah, I think one of the areas to look at, Cheryl, is emerging markets. Emerging markets have been out of favor again, but their PEs are quite a bit lower than the U.S. markets, and growth in earnings and revenue looks to be really on the uptrend. That could be an interesting area to kind of hedge some of this U.S. equity exposure. I also think just looking at some of the equity plays out there that might have global exposure in industries that are growing but maybe are defensive. So cybersecurity is an area. There's an ETF hack that plays that. We've talked about that in the past as well.
Mark, I do admire your stomach and the stomach of Matt as well. You guys are willing to face all these walls of worry and say, don't worry about it, buy on the dips. Are you, today it wasn't much of a dip. It didn't end up as much of a dip. But were you buying today? If tomorrow it's down 200, 300 points, will you buy tomorrow?
David, we are and we would. And the fact of the matter is I would welcome a little bit more selling pressure in the equity market. I think it would be advantageous then to put opportunistic money to work in this market, because I think even if we would test the 200-day moving average of 2010 or somewhere around that level, I think that would be very inviting. I think it would reignite energy for buying into the equity market, because I don't think whatever catalyst it might bring to have the market sell off by even that much is enough to derail this bull market.
All right, guys. Thank you very much for all the commentary. We certainly appreciate it. And, Matt, I know you had some great picks. We'll get you back on real soon.
We will indeed. Yeah, we owe Matt one.
Yeah.
Thank you to all. I appreciate it. All right.